Welcome back to our channel, Clear Valley Tax. My name is Brian Kim. I'm a certified public accountant, and today we are here to talk about the sale of a rental property. So, the full equation for calculating this out is the sales price minus cost basis will equal your gain. Okay, so there's three pieces, right? The sales price is straightforward. The gain is straightforward. It's the cost basis that trips up everybody, or nearly everybody. So we're going to break this down for you. Okay, so you have sales price, you have cost basis, and you have your gain. So the sales price, that's very straightforward. If you sold your property for $400,000, then your sales price is $400,000. Straightforward. There's no tricks. It is what it is. It's very straightforward. Cost basis. Okay, cost basis here. Okay, these are the things I'm gonna have to read this one off. Okay, so cost basis is the purchase price of the home. Okay, how much did you purchase the property for? Plus the closing costs of when you purchased the home. Okay, so we'll get into that. Plus the closing costs of when you sold the property. Okay, well, I'm using the word home and property interchangeably. Okay, so the closing cost of the home when you sold the property, plus the improvements or additions that you made to the property, and then you subtract the depreciation that you've claimed over that property's history. So you're gonna have to look at the prior year tax returns or just look at the accumulated depreciation balance. So we're going to dive into all of those points one by one. Okay, so the cost basis, the first bullet point that we mentioned was the purchase price of the home. Piece of cake. How much did you purchase the property for? There's no tricks there. Purchase price of the home. Okay. Moving on. The closing costs of when you purchase the property. Okay, those are going to be title charges. They're going to be transfer taxes. They're going to be settlement costs. They're going to be attorney's fees. They're going to be on the HUD statement or the settlement statement of when you purchased that property. If you bought that property 10 years ago, you got to dig up that document from 10 years ago. They're all going to be listed on that statement, the HUD statement or settlement statement. So you need to dig that up because, from our experience, those are going to be in the, 10,000 or more. It's a really big number. You do not want to miss those. So dig that up. Dig up the HUD statement or settlement statement from when you purchased the property. Okay, moving on to the next bullet point was the same thing, but it's on the sales side of it. So you just closed on the property. Got it? Right? So the closing cost of when you sold the property. Those will be the same things. The title charges, transfer taxes, settlement costs, attorney's fees, etc. But additionally, what you're not going to find on the purchase side is that when you sold it, usually you're going to have, if you work with a broker or a realtor, you're going to have the commissions, and those are going to be huge. Generally they're going to be large. Generally they're going to be, anywhere from 5 to 6%. If they're not, or you sold the property yourself, that's great. You save money, but even you might have had to pay the buyer side commission. So please do not miss that, especially the commissions. That is huge. Okay, so those are the closing costs of when you sold the property and when you bought the property. So don't forget those. You need to dig up those statements on the sale and when you purchased it. Okay, and then you're going to have the improvements or the additions that you made to the property during the course of the property's life. So if you upgraded the home in any way, you do not want to forget that because that's going to increase your cost basis, which is good for the tax equation. So if you made an addition or you did some remodeling, so you should have captured that on the Schedule E when you were filing your taxes for the rental activities during that year. But if you didn't, still, please don't forget those. And if you did capture those on your Schedule E in the year that it did occur, Okay, good. Just don't forget to add that to your cost basis. Okay, so those are the four additions to the cost basis: the purchase price of the home, closing costs when you bought the home, closing costs when you sold the home, and the additions or improvements that you made to the home. So those are the four cost basis items that will increase the cost basis, which is good. Okay, because that's going to reduce your gain. Now, the one thing that you subtract in the cost basis calculation will be the depreciation that you've claimed. So for this, you need to see what your accumulated depreciation is. Accumulated depreciation is for that property, for the life of that property, because that's going to subtract and reduce the cost basis. Okay, so you're going to have the sales price minus your cost basis, and that'll give you your gain. Perfect. But, that's, you have your gain, but what rate? What rate are you going to use? It's not, you can't say, oh, it's going to be 15%, the federal long-term capital gains rate. No, it's not that simple, because you need to take into consideration depreciation recapture when you're selling the property for a gain. Okay, so before we get there, let's give an example of calculating the cost basis so you can see it and you can work with it. You can work with me through this to see with your own eyes how this calculates, how it flows. So I'll just read off an example. So in this example, let's say you sold your property for $400,000, okay? Property sold for $400,000. Now let's figure out the cost basis. Let's say you bought the home, you bought the property for $300,000. Okay, closing costs when you bought the home were $5,000. Got it? You made improvements to the home for $15,000. Okay, that's going to increase your cost basis. The closing costs when you bought the home will increase your cost basis. The improvements that you made to the home will increase your cost basis too. Closing costs when you sold the property were, let's say, $20,000. So that's going to increase your cost basis by $20,000 more. Okay. So let's say in this example, the depreciation that you've claimed on the life of the property is $50,000. Okay. So what is the cost basis now? So the cost basis is the $300,000 that you bought the home for, plus the $5,000 of closing costs when you bought the home, plus $15,000 of the improvements that you made, plus the $20,000 of the closing costs when you sold the property, minus the $50,000 of depreciation expenses, the accumulated depreciation that you claimed over the course of the property's life. Okay, so now you have a cost basis of $290,000. You sold the home. You sold the home for $400,000. So that's a gain of $110,000. Okay, so it's not going to be $110,000 a gain times 15% federal income taxes. No, that's not how it works. Okay, because you're ignoring something so crucial, which is the depreciation recapture. And the depreciation recapture has its own rate. So let me just give you the quick backstory. So each year on the Schedule E, that's the rental activities, income and expenses, you are claiming depreciation expense. Okay? And that's helping you. You're benefiting. You're claiming depreciation expense. You don't get that for free. It's going to come back to bite you, and you can't do anything about it when you sell the property. That's called depreciation recapture. You get the benefit as you're renting it out, but you don't get the benefit for free. It's kind of like a tax deferral mechanism where you get the benefit in those current years, and then it comes back to get you when you sell the property. Depreciation recapture. Okay, we're not going to talk about all the tax tricks that you can do to avoid that, like-kind exchanges or opportunity funds. We're not going to talk about this. We're talking about just the straight-up sale of the property. You want the funds, so There's none of the deferral mechanisms, and you're going to face the depreciation expense recapture. Okay, so the tax on the gain in this example, if we're saying that you have 110,000 of gain, you have to know what your accumulated depreciation was, right? It was 50,000 in this example. That's important because the depreciation recapture rates are 25%, much higher than the 15% for long-term capital gains rates. So you will pay depreciation recapture rates up to the extent of how much depreciation you've claimed on the property. So in this example, you've taken 50,000 of depreciation during the course of the property. So up to the extent of $50,000 of gain, you will pay taxes at a rate of 25% on the first $50,000 of gains. The excess, the remaining $60,000 of gains in this example, will get taxed at your long-term capital gains rates of 15%. Okay, so that's the difference. To clarify, let's say the accumulated depreciation expense was $20,000 over the course of the property, and let's stick with the gain. The total gain is $110,000. So in that example, you would pay depreciation recapture rates of 25% on the first $20,000, and then the remaining $90,000 would get taxed at the 15% rate. So that's why the accumulated depreciation, you have to take that into consideration because you're paying at a different tax rate than your long-term capital gains rates. So you need to remember that, especially if you're trying to ballpark. It's in the middle of the year. You're trying to ballpark what your gain is, what your tax liability is, and you want to make an estimated tax payment. So use the appropriate rate. You need to know that the rate is 25%, and that might be substantial if your accumulated depreciation is substantial. It might not be so substantial if you only rented out your property for 1 year, 2 years, and the accumulated depreciation is minimal. In that case, if you have a large gain, the majority of those gains will be taxed at your long-term capital gains rates. But in the event where you're renting out for 10 years, 20 years, or 27 and a half years, then that's a situation where probably a majority of your gains, it could be a majority of your gains would be taxed at 25%. It's a big difference, especially if you're talking about gains on a property, which, they could be substantial. Okay, so that is kind of a very in-depth overview or a session about the gain equation for sale and rental property. This is not your beginner or entry level stuff for when it comes to tax preparation. So if you actually could follow what the heck I was saying during this video, kudos to you. That's very impressive, on your end. But if you have any questions or you need anything clarified, please leave a comment or question below. I'd be happy to get back to you. So, please feel free to take advantage of that. So thanks for tuning in, and we look forward to making more videos. Thank you so much.